What I have done for your benefit, I have broken the balance sheet into two parts. So first we will look at the liability side of the balance sheet, and then we will look at the asset side of the balance sheet. So in the liability side of the balance sheet, the first component, as you all will remember, is the shareholders funds. Now please remember, you call it shareholders fund. You call it you okay. In case if the in case if the company does not have the preference share capital, then it can also be said as then it can also be said as equity shareholders fund. But if you have a preference share capital, then you cannot call it as equity shareholders fund, because preference share capital does not belong to the equity shareholders, and that is what we should remember. And these are the nuances of finance, that we need to capture in our mind always. We all understand what is equity share capital, does not need any elaboration. We also know what is preference share capital, does not need any elaboration. We also know share premium, does not need any elaboration. And we also know what is reserves and surplus. It also does not need any elaboration. But friends, here I would like to tell you something, and that is the reserves and surplus. This figure is number one, is only a paper figure. Is only a paper figure, because many times I have seen while delivering these programs all over the globe, people sometimes build a misunderstanding about reserves and surplus, and they start feeling that if the reserves and surplus figure is 50,000 or 5 lakh crore, it means this company is sitting on a cash of 5 lakh crore somewhere, and that is why it is known as reserves and surplus. It is not so. It is not so. The figure of reserves and surplus, friends, remember, it only tells you one thing. And that one thing is, this company, ever since got promoted, ever since started operating, has earned a lot of profit. A part of that profit company has given to the shareholders as dividend, and so much of amount which is coming, which is showing in the balance sheet as reserves and surplus, company has flowed back into the business. So this is the simple meaning of reserves and surplus. It has got another significance, and that is what you must remember. Just the company, any company, higher the amount of reserves and surplus, stronger the company is supposed to be. Higher the amount of reserves and surplus, stronger the company is supposed to be. Why? Because if a company is having reserves and surplus of 50,000 crore, now what does it mean? It means what this company has done. This company has earned a lot of profit in the past, and 50,000 crore out of that profit the company has plowed back into the business. So what is the meaning of plowing back into the business? That means with that 50,000 crore, this company has expanded the operations, it has done the modernization, it has done the expansion, diversification, organic growth, inorganic growth. So 50,000 crore worth of more assets the company has created. And remember, if the company has created more assets, that means what? That means company has created more revenue or generating capacity. If the company has increased the revenue generating capacity, it means what? It means the company has established or created more profit earning capacity. So higher the profit earning capacity a business has created, so much better it is for a company. And that is the significance of reserves and surplus. So please remember, reserves and surplus does not mean so much of cash is lying with the company. It only means if this amount is big, that means company is very, very strong. Let's look at the components of non-current liabilities. So long-term borrowing, and I'm sure you understand, is very simple. Any loan that the company has taken, and on the date of the balance sheet, it is going to be paid back by the company beyond a period of 12 months. That is known as long-term borrowing. Now here, friends, you must remember one thing. Whenever you are disclosing long-term borrowing, you have to segregate the long-term borrowing into two components, and this is where you need to pay attention. Why do you have to segregate the long-term borrowing into two components? Please remember, on the date of the balance sheet, when you are making the balance sheet, that is 31st March 24, part of the long-term borrowing that is reflecting on the balance in your books will be paid as EMI in next 12 months. So to the extent EMIs which are to be paid in next 12 months, remember your long-term borrowing is not long-term borrowing, it is short-term borrowing. So what you will need to do, your long-term borrowing you will need to segregate into the component which is going to be paid beyond 12 months and the component which is going to be paid in the next 12 months. So the component which is going to be paid in next 12 months, remember, it will not be part of your long-term borrowing, it will be part of your current borrowing or current liabilities. Deferred tax liabilities, remember, as I said, because of the timing differences or because of the permanent differences and because of the many reasons that I mentioned in the beginning of this session when we were discussing the P&L, it is possible that you get tax benefit. And when I say tax benefit, really speaking, these tax benefits are not tax benefits, they're only cash flow benefits. So because of the some tax shelter that you have, tax shield that you have, you will end up paying lower tax in the current year, but this tax will need to be paid in the future year. So that is why when you have a deferred tax expense coming in your P&L, correspondingly you will have a deferred tax liability coming in your balance sheet. Now, as per the accounting standards, please remember the deferred tax liability is always to be recorded as non-current liability. So in case if you have deferred tax assets or in case if you have deferred tax liabilities, please remember accounting standards say that these are to be by default recorded always as a non-current liability. And why they are to be taken as non-current liability? Understand the logic. Logic is very simple. On the date of the balance sheet, you are never sure whether this deferred tax liability will be paid by the company in the next year or in the subsequent year. Since there is an uncertainty with regard to the deferred tax liabilities or the deferred tax assets with regard to as to when they will be fructified, and that is the reason these are always shown as non-current liabilities. Then you got other long-term liabilities. So remember, long-term borrowing is one. Long-term borrowing is when you have taken the money. So that is going to come in the balance sheet as long-term borrowing. So when you have borrowed the money, cash, long-term borrowing. But you can always have long-term liabilities. So what is the long-term liabilities? You have purchased the plant and machinery from some supplier in Germany or in Europe somewhere, and the understanding between the contract that you have signed that the payment of this plant and machinery will be made by you after 2-3 years or things like that. So it is not going to be paid in next 1 year, it is going to be paid by you to the supplier in next 3-4 years. So this is your other long-term liability. This is not your borrowing, this is your other long-term liability. And then you have long-term provisions. So what are the long-term provisions? Now friends, before I discuss with you what are the long-term provisions, I would like to mention here for the benefit of every one of us, we need to be very clear as to what is the difference between a liability and a provision. What is the difference between a liability and a provision? And friends, let me tell you, the difference is very simple. When the amount that you have to pay is frozen, is known to you, that this is the amount that you have to pay, it will come in your books as liability because you know how much is the exact amount that you have to pay to the party. When the exact amount that you have to pay is not known, it is only an estimate, it will come in your balance sheet as a provision. So this is the difference between the liabilities and the provision. I'm sure it is clear to every one of you. Amount is frozen, you know exactly how much you have to pay, it is a liability. Amount is not known exactly, you only have estimated it, it is a provision. So your liability can be long term, your liability can be short term, your provision can also be long term, your provision can also be short term. Example of long term provision. So friends, Tata Steel है, Tata Motor है, हिंदुस्तान यूनिलीवर है, बजाज ऑटो है, ArcelorMittal है, all those companies, they have employees working with them for years altogether. Now, in respect of all these employees, as I was telling you in the beginning, in respect of all these employees, all these companies have to make provision with regard to the superannuation, with regard to the gratuity, with regard to the leave encashment, and some other benefits of this kind. Now, all these provisions company has to make But these provisions are estimates, because you do not know exactly how much that amount is going to be, so you estimate, and that is why they are known as provision. And these amounts will be paid to them from time to time to the employees who would be superannuating. So that means what? That means these are your long-term liability, long-term provisions, and this is what your long-term provision is. And then we come to the current liabilities. In case of current liabilities, short-term borrowing, I am sure you all understand all the loans that a company has to repay within a period of next 12 months is a short-term liabilities. Trade payable, of course, very simple. As a company, as a business, we purchase material from our suppliers on credit. So whenever we are purchasing material from our supplier on credit, that means the credit may be for 1 month, 2 months, 3 months, 4 months. We are going to make payment to our suppliers only on the due dates. So as on the date of the balance sheet, whatever amount that you are required to pay in future to your suppliers for the material that they have supplied to you will reflect in your balance sheet as trade payable, right? So trade payable, remember, are like creditors. So trade payables are your creditors. Then you got other current liabilities. So other current liabilities can be what? Remember, in business, not only you purchase material, but you also avail services. So in a factory, in a company, in an office, you will have people giving you service of housekeeping, giving service of the internet, giving service of power, giving service of security. Now, all these payments which are due to them on the date of the balance sheet are to be accounted for as current liabilities. And why current liabilities? Because all these payments that you pay to them are going to be in next few months, and definitely next 1 year, and that is why they are known as your current liabilities. Your salary that you will pay in the next month is also part of your current liability, because it is going to be paid just in next month only, and not even 1 year. And then you also have short-term provisions. So remember, I'm sure you would remember the difference between the liability and the provision. Liability, amount is frozen, you know exactly how much you have to pay. Provision, you do not know how much money you will need to pay. So you make some estimate, and that estimated amount comes in your balance sheet, and that is provision. And let me also tell you, friends, why does it have to come? And that is because we all know there is a concept of matching concept. And what is the matching concept? The matching concept is expenses pertaining to an income should be recorded in the same period in which the income is being recorded, right? So it is possible that the sale that you have made, you will have to incur certain expenses on warranty in the next year. How much that amount is going to be, you do not know. So you will need to estimate that amount and make a provision in your books as provision for guarantee. Likewise, you will make a provision for bad debt. So based on your past experience, how much is going to be your bad debt, nobody would know. But it is going to happen definitely. So what you do? Should you ignore it? If you ignore it, your P&L will not give the correct position, because the bad debt that pertains to the current year are not coming in your P&L. So your P&L is overstated, and that's not a right thing to do. So what you do, you make a provision for the bad debts on estimated basis. Now, since these bad debts are going to happen in next 1 year, and that is why you would record them as short-term provision. Now let us look at the asset side of the balance sheet.